Can everybody see my screen?
Yes.
Okay, great. I'll just go ahead and get started. Welcome everybody to the third session of the third and final boot camp of this summer. Today is going to be focused on the balance sheet, which is one of the three financial statements. So we've come a long way in a very, very, very short period of time. Usual housekeeping. Turn on your video, particularly when you're interacting. Because I'm in a different location today, now there might be times I might have my video on just to save bandwidth. Feel free to put any chat or reactions in the chat, and the one of the team members from Congress Heights will let me know your question or response to the topic. Other than that, please be on mute so we can reduce any outside noise. And again, I'm in a different location than normal, so if I need to mute myself, I do apologize in advance and we'll let you know. And the session is being recorded. Thank you again for Congress Heights hosting this series and the sponsors being DC government. My contact information, feel free to reach out if you have any questions or you want to schedule a one-on-one session. It's all part of this program, so feel free to do so. Let's see. Okay, so we're in the third session. Again, today we're focusing on the balance sheet. And then on Thursday, we're going to wrap up and talk about how we use these financial statements as part of the business planning. Okay, so we're going to cover the basic elements of the balance sheet as well as some key balance sheet financial ratios that you should know. So it's very similar to the format we had last week. Oops, sorry. Just gotta move some things up right here. Okay, a little review and reflection. So as always, we've started every session. If anybody has any reflections on their key reason for starting a business, feel free to share throughout the session as it comes to mind. We went over some key challenges many business owners will encounter as they get the business started and, taking all the actions to grow your business. These are all very natural, but just being aware. And being aware of these challenges may help us know how we are being influenced in our decision making. Definition of a business, once again, operation provides a valuable offering to a customer or a group of customers in exchange for a payment. We have noted many times that an operation is legally established, is organized, insured, all that good stuff is in the products and services along with the customer experience is what we define as the valuable offering. There could be a group of customers or several groups of customers that you could be targeting. So, you gotta be on the mind, you gotta have a mindset to be on the lookout for how do you expand your market. In exchange, the business is going to collect timely payment and is going to do it in a very efficient manner. The business does not operate in a vacuum. So both an internal environment and external environment. So please pay attention to that. In our last bootcamp series, we talked a lot about marketing and went into all these factors. But just know that these factors may be a threat to the business, but they're also a source of opportunity. The business as an organized entity is made up of a series of systems. And this is just a little schematic of all those systems. Different authors classify them differently. And this bootcamp is focused mostly on the financial systems. That mainly being reporting the financial statements. And so if that's a definition of business, this is a definition of a profitable business. So in a nutshell, all the money that goes into the business, meaning starting and establishing the operation and growing the operation, developing and producing the product, as well as reaching out to customers and securing them as a customer and collecting payment. There's money that goes into all of those activities. So the money goes in, and the money that's collected that's coming into the business has to be larger than the money that goes into get the business operational. Next, we did cover a lot of financial documentation, so to speak, that you should keep track of. We're going to review these again in Thursday's session because you're going to need all of these items when you come down to business planning. But this particular book has been focused on the financial statements. Also want to highlight these financial statements are going to be linked to your credit report and your credit scoring. So we'll talk about that again on Thursday. But just as a reminder, if you haven't ordered your credit report yet, please go ahead and do so, as well as your checks credit report as well. And so here we are. Cash flow statement we covered last week. So that's money going in and out. The profit and loss statement, also referred to as the income statement. And here we are now at the balance sheet. As we recall, the cash flow statement reports all money going in and out of the business. So this is one of the examples we went over during our last session, and I just wanted to highlight. And in this particular template, the format was using the parentheses, meaning it's a negative number. So just keep that in mind. There are very variations to the templates. Don't let it throw you. Be very comfortable in knowing that it's just another format. It's nothing new. We went over an income statement. This is one of the most complex ones we went over because we talked about EBITDA, which is a very advanced topic, but nonetheless, we wanted to introduce it to you here. So income statement focuses on revenue, knowing your cost of goods, your gross profit, differentiating from that, and the net profit. Okay. From the income statement, so two key financial statements we focused on, even though there are more. And as you can recall, in the first and second session, we gave you a list of free resources, through them being 2 accounting textbooks that you can download for free. The one from OpenStax, I looked at it today just to click around to see how it was presenting the topic. It has a very good section on financial analysis, where all the key financial ratios are located. So please make sure you download it. But from the income statement, 2 things, if you don't learn anything else, you're always going to want to understand the gross profit margin and the net profit margin. And so those are the equations there. And so as that's our review, that's what we've been covering for the last 2 weeks. So that's 3 sessions, about an hour and a half each, covered a lot of ground in a very short period of time. So before we get started into today's new material, any questions, thoughts, feedback, any reflections anybody might have from their previous sessions? Nope. Great. Thank you so much. Let's move on then. All right. So today, the balance sheet. Okay. It's probably one of the overlooked financial statements because it's reflecting a financial information about the business that most people don't think is as important as maybe the money going in and out, or knowing your profit. But this one is critically important. And again, make sure you're using an accounting software. We gave you a list in session 1 and 2, if I'm recalling correctly. If you have an accounting software, it is going to automatically generate this balance sheet for you based upon the information you put in. Let's go over a brief definition. Balance sheet, also known as a statement of financial position. It reveals 3 major areas of the business, and it's the firm's assets, the liabilities, and the owner's equity, also referred to as the net worth. You may also see in some templates, or you might see a shareholder's equity, which is the same thing. It just means there might be multiple owners or shareholders that have rights or claims to the business. It's composed of 2 columns. The first being an itemized of the asset and an itemization of the liability along with the equity. And that's why it's called a balance sheet, because each column must balance out to the other. They must equal, and in the numerical values are the same. And so it's very important to have good record keeping so the calculations can be very accurate. Now, if you go and maybe Google different templates, and there should be a template being posted in the chat for you. There are 2 variations how the columns are set up. One is the assets and liabilities are kind of on a vertical, like you see here in this example on this slide. And then there's another variation where the assets and liabilities are side by side. They are the same. Don't worry about it. It's a stylistic thing, which one you would like to use. It doesn't really matter. For this particular example, I use the vertical one. And it's also a Microsoft template, so it's easy and downloadable, but you could always make sure you pull it from the chat. Okay, so other key point about the balance sheet is that it allows us to use what we call the accounting equation. So the accounting equation means that our assets equals liabilities plus owners or shareholders' equity. And if you flip that around a bit, you can actually really say equity is equal to assets minus liabilities. So it is the balance sheet that you use to calculate the net worth, which is the equity of a business, is how much the business is worth. The worth, how much a business is worth is not based upon the income. It's based upon the assets and liabilities and how that calculates out. That's what's so important about the balance sheet. And unfortunately, it's the part that everybody leaves out. Okay. This slide here, I just wanted to kind of reiterate that point. I think in session 2 and 3, we had a brief discussion about the business life cycle. And you can see in the descriptions of each of the stages, there's a description of sales, costs, and profits. What you do not see on the business life cycle, you do not see any of the elements of the balance sheet. So you don't see the assets or the liabilities or the equity. So be mindful that yes, you want to generate sales. Yes, you want to manage your costs. And yes, you want to generate profit, net profit particularly. But you have to be mindful of the assets and liabilities of the business as well. And the other key point about the balance sheet, you have to keep in mind, unlike the other financial statements, being the cash flow statement and income statement, they reflect a time period that you're reporting. So whether it's for that month, for that quarter, or even that year, a balance sheet reflects the asset, liabilities, and equity of the business at this one point in time. So whatever the effective date is on that balance sheet, that's what it reflects. Any day other than that, the balance sheet could change. So you really need to figure out how often are you going to be looking at your balance sheet. If you're going to be looking at your other financial statements on a monthly basis, you might as well just go ahead and look at your balance sheet at the same time period. But just know it's only reflecting that particular day. And so it's quite natural for your balance sheet to change as you go from day to day, month to month. That is quite okay. What you want to do in your business planning process, you want to look back year over year to see what changes have been made, and are you hitting your goals in terms of building the net worth of the business in conjunction of managing the cash, in conjunction of generating profit. So let's break down the areas of the balance sheet. So first area are the assets. And so the assets have value, and they're the items that the company is going to use to operate. And so they're divided into two versions. You have the current or short-term assets, depending on what author you use. Most people use current, but there's also some authors that would use short-term. And then similar to that, you have the long-term or fixed assets. In this particular example, they use the term of fixed assets instead of long-term. So your current assets are those assets that have a lifespan of 1 year or less, meaning they are easily converted to cash. And when you're writing out your current assets, the cash is always written first because it is in its most liquid form. The remaining assets that are listed in how easily they can be converted to cash. So for instance, if you have investments, you have inventory, you have accounts receivable, meaning that a client or a customer owes you, so that money should be coming into the business. Or if you prepaid an expense, and if you cancel that service or whatever it may be, you should be able to get that money back. And so those are the current assets, those that can be easily converted to cash. The next group of assets are the fixed assets, and these are the items that fall in either one of three categories. They're not turned into cash easily, or they're expected to be turned into cash within a year. So it's much longer than the time period of the current asset, or they have a lifespan that's more than a year. most times the fixed assets represents those assets of business that the business has to use to actually operate. The biggest two being property and equipment, and whatever leasehold improvements you might be making on a facility or a property to run the business. You're not going to get rid of your property or equipment very easily. That's going to have to be on a very dire need. Or if you're, buying new equipment, you need to get rid of the old one, but you need those items to actually operate the business. Other types of fixed assets is equity or ownership and other investments. And so this is very common for a lot of corporations, is that they invest in other companies. This is typical example that you might want to, you could think about is Shark Tank. So each of those sharks, when they invest in a business, they're actually acquiring equity from that other business. And so they have part ownership. And so on their balance sheet, that ownership will be listed as an asset. Okay? The other type of assets, not everybody has this type of assets. It's called the intangibles. So these are not physical items that you could put your hands on per se. These are the common examples would be if you have a patent or if you have a copyright or intellectual property that the business owns. So they have some sort of value, but they are not the items that you can point to and say, oh, that's, here's the equipment or here's the inventory. The other subtype of asset under intangibles would be goodwill. So goodwill it's hard to pigeonhole it, but the classic example would be if you have customer loyalty. Now you might be thinking, how is that an asset? But if you've built a brand and you've built a following and you've built a reputation, that has a certain value because you can, as you push out products, it's going to be recognizable in the marketplace. People are going to buy because they know that brand. So there are some calculations, some ways you can put a dollar figure on those assets. And so those are your three major types of assets. So each of the values are noted in the column, and then you total them up to get your total assets. Okay? Any questions so far? And I see a few people have joined us this evening. For Congress Heights team, anybody posted anything in the chat that they need to be aware of? Okay, great. So those were the assets. So similarly, if those were the assets, meaning the things of value that the business owns, we talk about the liabilities. And liabilities are those financial obligations than which the company owes an external party. And that can be any bill collector, that could be any kind of loan, anything that the business might owe, that is called a liability. So the first group would be the current liabilities. And just like we talked about with the current assets, the current liabilities are debts that will come due or must be paid within a year. So just like the current assets are very short term, the current liabilities are those liabilities that are on a very short term. So that would be the accounts payable. So that's customers who owe you money. Maybe you've invoiced them, but you haven't collected payment yet. That might be the wages you have to pay out for a certain time period or any compensation. And so you have to be mindful of how your business operates so that you'll know which bills you have due so that it can be noted properly on your balance sheet. Next is your long-term liabilities. And these are debts or other financial obligations that are due after a period of after the period of 1 year from the date of the balance sheet. So the current assets reflect just 1 year span. The long-term assets reflect a very longer period of time. So the classic example would be the mortgage. So let's say your balance sheet is dated January 1. Under the accounts payable, you would add up all your mortgage payments for that year. So that's 1 year of the operating of the business. The remaining 29 years of your mortgage will be noted under the long-term liability. And that's where you gotta understand what the business owes, when does it owe it, and how long does it owe it, so you can properly classify your liabilities. Now, The owner's equities are not the same as liabilities per se. It just means that as an owner, you have rights to the business. You have right to claim the investment you put into the business, which is the investment capital, and any returned earnings. So the returned earnings are those profits that the business has paid all its bills, and whatever is left over, it's saved in the bank account or whatever vehicle it's being used. So the retained earnings and investment capital, that is owned by the owner has right to claim that. So that's what's called the owner's equity. And that leads us back to the accounting equation. So if you want an easy way, very easy way, let's say you have a very simple setup of your company, you don't have a whole lot of sophisticated asset and liability categories. Owner's equity can be calculated simply by subtracting the liabilities from the assets. So when you read articles or you're listening to the news, and then you have people who are saying, oh, their net worth is, what they're saying, their equity is X, Y, and Z. So when you say somebody is worth $1 billion or a company is worth $2 billion, it doesn't mean they don't have any bills. It just means that their assets minus all the liabilities and folks they got to pay is equal to $2 billion. They don't have $2 billion cash, okay? So keep that in mind, because a lot of people like to talk about how much they made in sales, but that doesn't mean profit. And a lot of people like to talk about how much they made, but that doesn't mean actual net worth. Okay? So let's take a quick break here. Anybody have any questions, any thoughts? Let's digest this for a second.
Also, I see Seydu joined from Metropolitan Solar. Hey, Seydu, did you want to do a quick introduction and kind of tell the group about your business and what do you do? Seydu?
Hello.
Yes, we
Hello,
can hear you
yes, go
now.
ahead.
Yes, you were on mute.
You know, no, actually, I'm good, actually.
Okay, Dr. Watt,
Hello?
guess
Yep.
we could continue. I think he's saying he doesn't have any questions or not able to do the introduction at the moment.
Okay, not a problem. And as I said before, periodically I might need to turn my video off. I'm in a different area than usual, so the Wi-Fi is a little funny, so you might see me go in and out. But I just want, because I want to preserve, make sure you have the audio. So, okay, no questions at the time being. No, not a problem. We'll just move right along to the examples. And just like the previous sessions, I have a couple of examples to help walk you through it so you can digest this information. And so here's the most basic balance sheet that I was able to find. And many of you will have a balance sheet that looks very similar to this, and that's fine too. As your business grows, your balance sheet, as well as the other financial statements, will get more sophisticated. So don't worry that your balance sheet or other financial statement doesn't look like the major companies. That's fine. So in this one, you have assets, and so you can see they have cash listed, so cash or cash equivalent. And they have inventory, and they maybe have some short-term investments. So that might be a money market account, there might be a CD, whatever the case may be. Very basic. So you'll probably have something similar. Their liabilities also very similar. So they have accounts payable, so they have some upcoming bills that need to be paid, and you have some short-term debt, all that's going to be paid out in the next year. Because remember, it's called, if they have it listed as short-term. So they don't have any long-term debt that lie outside of that 1 year period. So if I would use this as a balance sheet as an example, and I wanted to get the net worth or the owner's equity, because this is probably owned by a sole proprietor or a single member LLC, I would simply subtract the assets from the liabilities, and this business is worth about a little over $6,000. That's it. in a nutshell, this is a balance sheet. So let's go into a little one more, let's go into an example that's a little bit more complex. Here again, based upon the type of business, your balance sheets will look different. So don't try to compare yourself with other businesses. So here I'm going to introduce a couple of new terms. Many of you, it will not be applicable, but I just want to put it out there. So as you're looking to reading up on accounting and some basic accounting functions, you won't be thrown off by it. Okay, so on this particular balance sheet, this is for a corporation. Corporations are far more complex than a sole proprietor or LLC setup. So if you feel you have to start a corporation, be mindful, it increases the amount of work and organization you need to have, okay? So in this particular example, we have our current assets that add up to about 89,000. We have some additional investment of 36. We have some long terms of fixed assets. We have land, properties, buildings, equipment, all sound very reasonable. Then the value of all of those items add up to be 337,000. And then we have some intangibles, which all seems very appropriate, goodwill and some others. So this, you see other here, this might mean they have some intellectual property. They might have, a brand or even a domain name that has some value to it. And so the total assets are 770K, okay? Their liabilities, all kind of reflective of the same. You have some short-term loans. We have the current here, it's even stated the current portion of a long-term debt. They have some accounts payable, some accrued compensation, deferred revenues. You see, that's a new term for us. So I made sure to provide you a little bit of information on that. So that just represents prepayment from a customer, but they haven't received the goods or services yet. And I made sure to just to kind of point this out because some of you will be government contractors, and so in some instances we do have times where the government might prepay for upcoming goods, services, or products. So just be mindful. You might have to categorize that kind of payment differently than just our regular liability. But it is listed as a liability because if they were to cancel the contract or whatever the case may be, you do have to refund that money, so that money is owed back to them. Okay. So we have some long-term liabilities and total liabilities. And then it goes into stockholders' equity. Here again, they use a slightly different terminology with stockholders. Don't fret, it simply means owner's equity or another term of shareholders' equity. In this particular example, we have what's called common stock, which just means that that's the book value of all the shares that were sold by the business. And so if you have a corporation, you have the opportunity to sell shares if you opt to do that in your legal setup. And so the value of those shares that you have sold will be listed under the common stock. We have retained earnings, as we mentioned before. So those were the profits that were kept by the business. And then here we also have what's called treasury stock. So that represents a number of shares that have been repurchased by the business from the open market. So common stock is the value of stock you sold to others, I mean, you have taken on other owners. And whereas treasury stock are those shares that you have bought back to the business. And if you listen to a lot of business news programs lately, there are a fair number of corporations that are buying back their stock. So they want to take back ownership control and reduce the number of owners. And so that will be listed as treasury stock. And as you can see, by the time you get to the total of assets and liabilities plus equity, it balances out to be the same on both sides, 770K. This is just, again, to illustrate, if you're going to do a corporation, you need to have a lot more record keeping to making sure you're recording all of this information appropriately, okay? And one more example here. So a couple of new terminologies that come up on this example that differ from the others are what's called accrued expenses. So they represent company obligations to make future cash payments. So The reason why it's called accrued, because this indicates that this business is using the accrual method of accounting. So there's the cash basis and the accrual method. This means that you're reporting a liability the moment it is obligated or committed to, even though you might not have received the actual bill. And the reason why it can be an estimate, because it might be a difference when you actually receive the bill from your supplier or vendor or whatever. You might have negotiated different terms, but as soon as you commit to buying a product and services, because that's the accrual method, you would note this as accrued expense. Also here, this particular example has another term called additional paid in capital, another accounting term referring to money an investor pays above and beyond the par value of the stock. So we're back to an example of a corporation here that is selling stock, meaning taking on ownership so they can collect investment money. And in this case, that investor paid more than the actual book value of the stock, which can happen. It's all about supply and demand. And so that difference would be noted as additional paid in capital. Again, 99% of you will probably not have this scenario, but wanted to just indicate it here that as your business grows, your balance sheet and other financial statements will become more and more complex. And so you will have to learn more and more information. You'll have to learn new terminology. So don't be afraid. We're introducing these concepts to you now. Don't fret. As long as you understand the fundamentals of assets, liabilities, and equity, you will be fine. Okay? Anybody have any questions, any thoughts as a result of those examples of the balance sheet? I'll give you a few minutes to kind of think that over. Let me flip back here. Okay, does that mean we're all good? Anybody posting in the chat? Everybody's feeling okay? I know it's a lot of information. It's a lot of new information. But how's everybody feeling about it? Okay, Ms. Dominique, thank you for the thumbs up. Okay.
I got a question, Dr. Walker.
Sure.
So in terms of, the assets and liabilities and stuff, if you are not, like, for example, you own a daycare, for example, because they turn over equipment, but let's just say you have the same 10 chairs and desk in a daycare and or stuff like that, and you almost never change it. That's not true. A sports related business, right?
Okay.
You're a trainer and you literally just add on clients, and you have much of the same stuff like cones and a couple other items. As you grow, like, does your equipment list have to change, do you think?
Your equipment list per se does not have to change, although in many industries you might have some variation as new equipment, new items come out on the marketplace for an industry, but you do have to be mindful of the depreciation. And so what you bought in 2020, and you bought it new, over time, it's going to lose its value. So that's another beauty of having using an accounting software. Many of those software programs will calculate the depreciation based upon the general type of equipment or property or whatever it may be. So your assets per se do not stay static, even if the activities of the business stay static. And that's the critical thing about tracking your balance sheet, and not just the cash flow or the income, revenue, and cost of goods. And that's what a lot of businesses overlook, because as small businesses, when you go in for a loan, the banker is going to look at your balance sheet to see how much of value do you have in the business? What can be converted to cash in the event that was the last ditch effort to pay the loan off? So your
Yeah,
equipment item may not change, but the value will change.
got it. Got it.
Yeah, I hate to admit that, because if I paid $2,000 for a brand new computer, not to say I'm telling on my business, but I bought a good computer with a lot of memory, because that's what they advise you to do.
Yeah,
And year after year, that thing is gonna depreciate, and so I feel some kind of way about it. But here's the other kicker about your assets, particularly when it comes to property and equipment. The items that a business buys for the use of the business is called personal property from a tax perspective. So from a tax perspective, you want it to depreciate, so you pay less and less taxes on the assets of the business. So just keep that part in mind. It's a great question.
got it.
Anybody else have any questions? I know this all seems a lot of complexity, but here's the thing, you guys, most of you are starting out, or if you're making less than $5 million or something like that in gross revenue, a lot of this is not applicable, but you just got to understand the basic concepts, because then you'll be able to understand your financial statement. Okay. So just like last time, that was a review of the actual statement. Now, the benefit of generating your financial statements is doing some analysis. And that one way you're going to do that is through calculating some key financial ratios. And so these financial ratios is taking information from that financial statement and using just some basic calculations. And it tells you a lot about your business by just generating these calculations, even if you don't have to, if somebody doesn't see your complete balance sheet. So the balance sheet has numerous, just like the income statement. So the income statement, I emphasize that you need to know your gross and net profit margin. On the balance sheet, there are a few more you need to have under your belt and look at on a regular basis, okay? And if you're going to go for a loan, or you're going to talk to an investor, they are definitely going to look at these ratios, even if they don't look at the entire balance sheet, right? So the number one that you'll probably see in any article that you read or any chapter on the subject is going to be the current ratio. So the current ratio is a measure of the liquidity of a business. And when we say liquidity, we're talking about how much cash is in the business and how easy is it for you to get to the cash, okay? So the current ratio is equal to the current assets divided by the current liabilities. So a high liquidity means that the company has enough money, meaning in a format or enough assets in a form that can be easily converted to cash to pay off any unexpected debt or expenses that might come up. So in this example, let's say you have $30,000 of current assets, and you have $15,000 of current liabilities. Remember, we're talking about the current within the 1 year time period. So that'll be $30,000 by 15. That's a 2-to-1 ratio. This means the business has twice as many assets as liabilities. So that can give somebody who's looking at it saying, okay, if this business needs to pay off a bill or unexpected debt, it has sufficient number of assets, current assets, that it can convert to cash rather quickly to pay off that debt. There's a debate upon which, depending on what articles you read or which author you read, there could be some debate among which the appropriate ratio. This is generally what I've seen, 1.5 to 2 or higher is adequate. But here again, here's the kicker. And this goes back to our marketing boot camp, actually. You must understand the type of business you're in. You must understand your industry, because this 1.5 or 2 can vary by type of business and industry. But just keep in mind, 1.5 to 2, that means you have more assets than you have liabilities. So somebody looking at the current ratio can be like, okay, this business has assets that it can convert to cash to pay off liabilities, okay? The next is the quick ratio. Very, very similar to the current ratio. The only difference is it takes into account the current inventory. So here you have current assets minus the current inventory. Now remember, inventory is an asset. So in this particular equation, you want to take it out of the equation, but you're still dividing by current liabilities. This is more conservative measure of liquidity, okay, than using the current ratio. So, and let's say in this example, you have 20,000 in assets, and you have 10,000 in current liabilities with 2,000 in inventory. So here in this example, you would, I'm sorry, I think I have a little error here. It should be 20,000. You're taking out the $2,000 because you don't want to account for the inventory in this particular case. You want to look at all the other assets and say, does this company have enough assets, excluding the inventory, to cover any liability? So in this example, it says 30,000 minus 2,000. Again, I will correct the error when you get the final handout. And if I divide it by 15,000, you get a 1.867 to 1. So a quick ratio greater than 1 is usually a safe ratio to have. Again, it will depend largely on the type of business and the industry you're in. So this is emphasizing that not only do you have to have a good handle on your current assets, you have to have a good handle on a particular asset being the inventory, okay? And that will change over time, as we have said earlier in the presentation, that your balance sheet will change. This is a reflection of the business on that particular day, okay? Any questions there for anybody?
Yeah, I just want to understand the 15,000. Is it that a debt or where did it come from? The 15,000.
So this is my error. This is should be 10,000 here, but let's say the example is you have 30,000
okay.
in current assets, you have 2,000 in inventory, and 15,000 in current liability. So this current liability will be all of the debt owed by the business that will be paid off within a 1-year time period of the balance
Thank
sheet.
you.
So it's all short-term debt. Great question, though. Thank you. So again, my error, I'll make that correction when you get the final handout. I think that's my haste as I look at multiple examples to see what would be most appropriate for this presentation. Okay, so we went over current, we went over quick, and those deal with current asset and liabilities. Working capital also looks at current assets and liabilities, but it looks at it in a slightly different way. So here, instead of dividing, you have current asset minus current liabilities. So you're taking the difference between the two, because a healthy working capital means that the business can take out debt if it needed to grow really quickly. So you got a contract, you need some debt financing to get you through that new contract. It means it can take on debt without getting into financial problems. So in this example, company has $40,000 in current assets, and it has $20,000 in current liabilities. So if I was subtracted two, that means you have $20,000 in working capital. That meaning that all of the current assets, if I had to convert them to cash, they could easily cover all of the current liabilities and then some, right? Now, this was where the industry standard may be a little tricky, and you really have to dig deep about what your industry is in. In some cases, the working capital metric could be a positive or negative. And whether that is the number is positive or negative is largely dependent on the industry. Now, on Thursday's session, I'm going to go over a few sources of information where you can do research to see what your industry and the common ratio metrics for your industry. So just know, we're back to the same old issue that we talked about in the marketing bootcamp. You have to understand your industry, and you have to understand the type of business you're in to know what's the appropriate metric for you. But no, it is very, very common for a banker or an investor to look to see what's the working capital available to that business. Okay? Any questions so far on that? Okay. moving right along, now we have debt to equity ratio. You probably heard of this a lot, particularly if you watch Shark Tank or some of the other business news channels. So here, now we're moving on from current assets and liabilities. Now we're taking the total liabilities, current and long-term, and dividing it by the total shareholder or owner's equity. So here you have to have your totals. And what this is trying to indicate is how much of the equity can cover the debts of the business, meaning how much can the owner pull out of the business? What is the net worth of the business? And can it cover all of the total liabilities of the business, short and long term? So in this example, we have 40,000 in liabilities, and then we have a shareholder equity or owner's equity in 25K. I do the division, and you end up with a 1.6 to 1. So this means for every $1.60 of debt, there is $1 of equity available to pay that debt. The lower the ratio, the better. Okay. Now, you don't want it to be absolutely zero where they both equal out to be the same and it comes out to be a wash, because that may indicate that the business is unable to get any debt. So that's what we call the inefficient capital structure. So the capital structure is the combination of debt and equities by a company to finance its overall operations and growth. And the reason why I put this here is because it is a safe bet that most bankers, investors, business owners, it's safe to say as you grow your business, that at some point you will have to take on some debt. And there is times in the growth of the business that it's appropriate to take on debt. I know some of us come from a culture sometimes, I don't want to owe anybody. I don't know how many times I've heard that from an entrepreneur or a client who's been a small business owner, but there are times it is appropriate to have debt. The thing is, you just have to manage the debt appropriately, okay? All right, so that's debt to equity ratio. And then our last one, a little bit more complex, but very, very important. And just so you know, I had talked this issue over, not with a small business, but with a nonprofit most recently. And so this is called, it's regarding solvency and its ability just to overall pay your bills. And so here, a solvency ratio is total net income plus whatever depreciation of the income divided by the total liabilities. Because what you're trying to look for is, does the business have enough cash flow to pay off long-term debts as well as meet its short-term debt obligations? So you're trying to see, can that entity, that business, do both, deal with the long-term as well as pay its short-term debt, okay? And if you don't have depreciation, and as you will recall, because we're just using the phrase total income, you will need your profit and loss statement to calculate the solvency ratio. So, but many of you, the way your business is structured, you may not have any depreciation on some of the income that you're generating from your business. And if so, then it's just the total net income divided by the total liabilities. And so similarly to the EBITDA that we talked about, where you're adding back in certain line items, here you're adding the depreciation on an income back to the total net income, because you want to see the totality of the income. Yes, we all know that some of you might have depreciation, but in this particular case, we just want to see what's the total income and what's the ratio of it, the income to the liability. So you will need your balance sheet and your profit and loss statement to do so. So let's see, in this example, the company has $25,000 in total income. Again, you're getting that from your income statement. And there was a $5,000 depreciation on one of the line items under income. Remember, the income statement has that little section towards the end that says other income, all right? And so in that case, it was $5,000, and that was subtracted on the income statement, but here we want to add it back in. So now you have 25 plus 5, that gives you 30, divided by the total 20,000, that is the total liabilities, long-term and the short-term. Ends up giving you a ratio of 1.5 to 1. That means the solvency ratio is 1.5 to 1, or 100%, 150% means the business has more than enough room to take care of any long-term debts based upon the income that it is generating. The other ratios we talked about, we're talking about the assets of the business. Here, this particular ratio is considering the income of the business. And so the solvency ratio of 20% or more is generally considered to be good. Again, there is variation on that based upon the type of business that you're in. Any questions here? I must emphasize that you need to know your solvency ratio. You need to know where your business stands in its ability to pay its bills based upon income. Okay? Any thoughts, any questions on this part? For the Congress Heights team, anybody posted in the chat?
No questions.
No, yeah.
Okay, good. We're moving right along. So those were some basic financial ratios from your balance sheet. Okay, so you can add those to other two financial ratios that we talked about from your income statement. Here is just a slide. I just want to highlight from a very practical point of view some of those hidden elements in the line items of the balance sheet that you might not be thinking of, but I just want to draw your attention. Remember, your liabilities, it also includes your employee wages and taxes. I have seen many businesses that have gotten into trouble. Not only did they not, remember to report or make their tax filings, but they didn't pay on their employee wages. And so that is a violation of law. And so you don't want to get into that trouble by, number one, not paying your employees, and number two, not paying the taxes, both the taxes that they are owed to the government and the taxes that you owe to the government for having employees. So be very, very careful when your taxes as a liability. Also, you might have other taxes based upon the type of business and activity that you're in, and you are required to submit a federal quarterly estimate, and then you have local income taxes for business and personal. And most businesses will have sales and use tax, but based upon your legal setup and your activity, you might have other taxes you have to pay. So be mindful of that they have to be captured on your as part of your liabilities. Also, sometimes I've seen this happen. You may pay for permits or licenses in multiple years at a time. I think for DC, you can get a 2-year license. Congress Heights team can correct me if I'm wrong. In many jurisdictions, you can pay for 1 year or you can pay for multiple years all at the same time. Note that is a prepaid expense. And so if the jurisdiction you're paying licensing or permits on has a refund policy, and most of them do. If you would have shut down the business during the time of the licensing, you get it's prorated, so you get part of it back. Just know that's a prepaid expense. So that is going to be noted on the assets. Also, your insurances. Most of us may do the month-to-month payment of the premium, and some of us may pay the whole year upfront because you might offer us a discount or whatever the case may be. That is prepaid, so you don't want to leave that off of the assets on the balance sheet. Your debt payments. So yes, your debt payments are going to be captured as expenses on the cash flow statement and captured as expenses on the income statement. They're going to be captured under the liabilities, and it may be both current and long-term liabilities on the balance sheet. But just know those debt payments may also be reflected on your credit report. So here is where your internal financial statement starts to overlap with an external financial record. So please be mindful of that. That some of the line items just don't stay within your accounting system and your knowledge base. It may be actually going to others. A couple other things here, the software or subscription, I particularly put for the software, but there are other subscriptions and fees that you may be paying as prepaid, so that will fall on the asset, or it may be an accrued expense, and therefore may it fall under a liability. And then lastly, the bank and credit card fees. Don't forget that your credit card membership fees may also fall into your liabilities. Maybe they're one of the future liabilities they have, but you know it's coming up, so it may be noted there. So don't forget those items off of your balance sheet. Okay. Any questions so far from just some practical advice on that aspect? Anybody has any thoughts about the information covered so far? I know there was a lot, but it's, you know, these are basic things you just need to know.
No question.
Was hype team any? Nobody, nothing in the chat as well. Just want to make sure.
No questions in the chat as well.
Okay, great. All right, so we covered a lot of information. And so here's what you walk away with. Number one, balance sheet is a snapshot. It's a moment in time. It's a reflection of the assets, liabilities, and net worth of the business on that particular day only. Okay? It's not the time period like the other, like cash flow statement in the income statement. And then you got to know your numbers. So not only do you have to understand the formatting of the balance sheet, you got to understand liquidity, working capital, solvency. You've got to be able to talk about these things in a very rational way. And because Thursday, we're going to talk about how this all relates to business planning. These key financial ratios are going to be very important for helping you make good decisions about your business moving forward. Okay. So that's all I have for you, everybody, tonight. I wanted to just be very focused on one of the financial statements, just like the other days. And so we've covered the cash flow statement so far. We've covered the profit and loss statement. And now we've covered the balance sheet, which covers all three major financial statements of a business. So if you've got this covered, you're good to go. So on Thursday, we're going to wrap up and talk about using the financial statement as part of the business planning process. Because it's no good just generating the statements and they just sit in the file folder or just part of the record keeping of your business. The key part, as we said in our very opening slide of session 1, is about decision making. You have to make decisions as the business owner, entrepreneur, to help grow your business. Okay. Any thoughts, questions? Feel free. You're welcome to ask any questions.